Hi, I'm Jackie Benson, an economist with Wells Fargo Economics. I'm joined here with Brendan McKenna, an international economist, to discuss our latest monthly economic outlook. So Brendan, we did downgrade our expectations for US GDP growth in Q1 of 2025. We originally expected GDP to grow at 3%, and we've since brought that down to 1%. So there was a few developments that prompted that change. First, consumers actually pulled back on spending in January, and that sets up personal consumption expenditures to be weaker in Q1 than originally expected. Second, we saw a surge in imports in January as businesses rushed to get ahead of new expected tariffs. So purchases bounced for industrial supplies, capital goods. This led the trade deficit to expand to its widest point on record going back to the late 90s. So speaking of tariffs, how are you thinking about tariffs and how they might impact global growth?
Yeah, thank you, Jackie. And maybe there's some useful aspects to just kind of laying out what our updated and revised tariff assumptions are. So purely from an assumption perspective, kind of underlying our global economic outlook, we're now assuming a 20% tariff on China goes into place. That's already in place, stays in place through the end of 2026. We're now assuming a 10% tariff on the European Union that is also in place through the end of next year. And then we're also assuming a 5% tariff on both Canada and Mexico that is also in place through the end of next year, and then a 5% reciprocal tariff on essentially all other major U.S. trading partners around the world. And I should mention that we're also expecting and assuming retaliatory tariffs from each of these economies and countries as well. So based on those assumptions, we're forecasting global economic growth of a little above 2.5% this year. That's a pretty meaningful step down from where we were at the end of 2024 when the global economy expanded a little over 3%, give or take. Now, as far as some of the underlying cross currents within the global economy, we are forecasting this month slower growth in Canada, given our revised tariff assumptions. Prior to this month, we had already forecast a Mexico recession, and now we're forecasting a bit of a deeper recession and even a more prolonged recession in Mexico. And then as far as the European Union and China, we're actually holding our forecast steady this year, and that's really on the basis of maybe some enhanced fiscal spending that's probably going to come through from the Eurozone and then also possibly China. So Jackie, I'll turn it back over to you. And how are we seeing the Federal Reserve kind of adjusting monetary policy settings in this type of tariff environment?
That's a great question. If our forecast comes to bear, the Fed is going to have to operate in a stagflationary environment. The consumer price index did come in below expectations in February. It rose at only 0.2%, but the year-over-year inflation rate has been essentially stuck in a holding pattern. Tariffs are likely to put additional upward pressure on prices, and because of that, we're expecting the Fed's preferred inflation measure to remain closer to 3% this year than 2%. Tariffs are also likely to weigh on the labor market and slow job growth. So our new forecast anticipates the U.S. unemployment rate to rise to 4.3% this year, which is a little bit higher than our previous forecast. So what's the Fed to do? Well, we think that the Fed is more likely to look through the tariff-induced inflation bump and more heavily prioritize the hit to the labor market. Because of that, we've actually added an additional rate cut to our forecast. We're now expecting a total of 75 basis points of easing this year. That would bring the federal funds rate down to 3.75% by year end. So Brendan, given our new expectations for U.S. interest rates, how is that affecting your outlook for foreign exchange rates?
Thanks, Jackie. And I should mention up front that for the most part, over the last 2.5, 3 months or so of this year, the U.S. dollar has really been under pressure, and it's been under pressure as a result of a lot of the dynamics that you just mentioned. Slower growth in the United States, a potentially higher unemployment rate, and maybe the Fed even delivers another interest rate cut towards the middle of this year, maybe even delivering 75 basis points of cumulative rate cuts in 2025. But even though the dollar has been under pressure over the last couple of months or so, we do maintain our view where the U.S. dollar can still strengthen over the course of 2025. And really, a lot of our underlying rationale for dollar strength does actually come back to monetary policy dynamics, both as it relates to the Fed, but also for major foreign central banks. And our thinking right now is that a lot of the major international central banks can at a minimum match the 75 basis points of rate cuts that the Fed is likely to deliver this year, or in some cases actually exceed the 75 basis point rate cuts. So as far as interest rate differentials, we do expect interest rate differentials to be somewhat in favor of the US dollar over the course of this year. And even when I'm just thinking about the actual terminal nominal policy rate in the United States, that's still likely to be higher than what we're seeing overseas. So purely from a carry perspective, there's still a decent amount of carry associated with the US dollar, and that should be a pillar of support for the greenback this year. Now I should mention, we've turned slightly less optimistic on the US dollar. And part of that actually comes back to some underlying fiscal policy assumptions that are poking through out of the Eurozone. We're starting to see increased fiscal spending. We're starting to see more defense spending out of the Eurozone. And as a result, maybe the European Central Bank is not going to be as dovish as we initially expected. We're also looking at a scenario where the Bank of Japan is still likely to deliver interest rate hikes over the course of this year. So the interest rate differentials that I just spoke about, maybe as they relate to the euro and the Japanese yen, and maybe some other foreign currencies, maybe those are not going to widen and swing in favor of the dollar as much over the course of this year. But again, nevertheless, Jackie, we're still optimistic on the prospects for the US dollar, and we're still forecasting dollar strength over the course of 2025 and even into the early parts of 2026.
Thank you. And from all of us at Wells Fargo, thanks for tuning in to another monthly economic outlook. See you next time.